When we last looked in on Enbridge, their fundamentals were less than ideal. It is time to look again and see if Enbridge is truly on the road to recovery. Fasten your seatbelts, folks. This is going to be a good one. Within the energy and utility sector, Enbridge is a giant. They can boast that they have one of the largest transportation networks in North America, and with more than 28,600 kilometers of pipeline, I would not argue that point. In fact, Enbridge moves about 30% of all the crude oil produced in North America, and that's not too shabby. In addition to crude oil, Enbridge has a strong focus on natural gas and renewable energy. With the acquisition of 3 U.S. utility companies in September of 2023, they have become North America's largest natural gas utility. As for renewable energy, Enbridge has 44 renewable projects in North America, which provide electricity to over 1.1 million homes. They have been working hard to advance new low-carbon energy technologies. This includes hydrogen utilization, offshore wind farms, carbon capture, and carbon storage, just to name a few of these socially responsible strategies. This is a company that has committed to reducing their carbon footprint with a goal of net zero emissions by 2050. Join the conversation. Let us know in the comments if you are currently holding Enbridge in your portfolio. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. 2023 was a mixed bag for the energy and utility sectors in Canada. For the most part, it began with a continuing slump that persisted well into the year, actually until the beginning of October. Once we moved into October, the sectors did recover towards the end of the year, and they did okay. Enbridge followed the sector, but at the same time made a huge strategic move in September to improve their overall situation and to cement their status of being a huge cornerstone of the utility sector. The deal with Dominion Energy to acquire 3 companies in the US was without a doubt a very good move for Enbridge. This all does sound pretty great, but as always, we need a little more to go on to make any kind of decision. So for that, we are once again going to turn to our good old buddy, Mr. Math. We will start with a little surface data. They have a current value at the time of recording of $49.46. Their market cap, that comes in at $104.71 billion, and their beta is just a wee bit slightly less volatile than the market average at 0.92. Their earnings per share, that comes in at 1.50. Now this is up 0.22 from last year when we did our last deep dive on Enbridge. Their price to earnings ratio, that comes in at 34.50, and the average amongst their peers comes in at 18.5. They are above the average, but with that September acquisition deal, I kind of expected this. Looking at a few of their peers, we do have Canadian Natural Resources with a PE ratio of 12.9, Pembina Pipelines comes in at 21.1, and Keyera comes in at 25.1. Moving to their price to book ratio, that comes in at 1.80. The average amongst those same peers comes in at 2.60. Their return on equity, that comes in at 4.98%. And this also is a little higher than last time, which is good to see because you know how much I love return on equity. Overall, the surface data is a little better than last year, and this is a good sign. So now let's peel back another layer and see what is going on with their cash situation. They have a revenue of $44.53 billion, and their earnings come in at $5.40 billion. Now, those earnings, they are projected to grow by 17.3% per year. That's pretty good. I do like that, and that will keep them in a position to maintain the positive changes we've already begun to see. Their profit margin comes in at 6.7%. They've got a free cash flow of $6.38 billion and an operating cash flow of $12.91 billion. It is nice to see that they do have a lot of cash moving around within their system. This is a good sign. Their current value is listed at $49.46. If we do a discounted cash flow model, we do get a fair value of $58.17. This puts them undervalued by roughly 15%. Last time they were slightly overvalued, so this is a huge improvement for Enbridge for sure. Looking at the analyst 1-year target, we do get $52.44. So analysts are expecting about a 6% increase in the share price of Enbridge over the next year. Once again, the cash didn't look too bad. I do like what I'm seeing with them so far. Let's continue the dive and move into their returns. Switching over to dividends, they have a yield of 7.40%. That is a quarterly dividend paid out in the amount of 91.5 cents per quarter. Their payout ratio, really high, 234.83%. This is still an unsustainable dividend. However, This is another statistic they improved in the last year, as it was 34% higher than that in our last deep dive. When we look a little deeper at that dividend, over the last 5 years, their average dividend increase has been 4.43%. That's not too shabby. Enbridge is a dividend aristocrat, and they are on a 28-year dividend increase streak. Okay, let's take a look at their returns. On the 3-year, their price rose from $43.34 to $49.46. That is a return on investment of 14.12%. We factor in their nice looking dividend and we get a total return of 38.14%. Moving a little closer to the 1 year, their price did fall from $55.80 down to $49.46. This is a return on investment of negative 11.36%. Factoring in the dividends, we're still on the negative 4.95%. These returns are what I was expecting, with most of the year being in a downturn for the sector. I do expect if we do this again next year, we will see a lot of improvement here. We still need to move one level deeper to get the big picture, and that involves taking a good old look at their debt. They have a total debt of $77.52 billion, and believe it or not, I like this number only because it means they reduced their debt by roughly $3 billion since we looked at them a year ago. That's pretty good. Their total equity, that comes in at $68.47 billion. That means we do get a debt to equity ratio of 113.2%. It should come as no surprise that this ratio dropped by 14% since our last deep dive. Enbridge is moving their debt in the right direction. It's undeniable. In addition, they do have some cash and cash equivalents, and that comes out at $2.99 billion. Let's take a look at their short term. On the short term, they have assets of $11.13 billion and liabilities of $16.73 billion. Not perfect, and you know I like to see those numbers reversed, but still it is better than last year. These liabilities fell by just over $3 billion. That's not too shabby. Switching to long term, they have assets of $167.28 billion and liabilities of $93.21 billion. Debt is not ideal and it is still relatively high, but the good news is that it is better than it was the last time we checked in. Higher debt and higher rates are a scary combination, and it goes without saying that rate cuts in the latter half of the year will be a huge help for Enbridge to keep on the current trend towards recovery. We will leave the debt situation for now, and we will have to ask once again, what is that final verdict? Enbridge is a blue chip company, and with their size, saturation of the market, and the heavy regulation in the utility sector, they have a nice looking moat. This is a company that is almost too big to fail. From a passive income position, Enbridge is an awesome stock to give your portfolio some blue chip exposure with a sizable dividend for income flow. They want to keep their dividend aristocrat status, so that dividend is safe and will continue growing. Enbridge has already demonstrated they can improve their fundamentals without any threat to the dividend. For a total return investor, this is a no-brainer. Strong dividend and a lot of potential growth as they move into recovery. You will not see a ton of growth in 2024, though the last half will begin to look pretty nice. However, on longer terms, there's a lot of potential here for some good, solid growth, and we also know they're going to be adding to that dividend, so that's not too shabby either. Overall, I do like Enbridge, and I do think it is a stock that can work for most portfolios. As usual, if you are interested in Enbridge, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Keep the learning going. Watch my video on exposure to Bitcoin, linked over on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.